What's the secret to accurately valuing a business in today's market? Is there a foolproof method that both Wall Street pros and Main Street investors can use? Today, we're diving into the world of EBITDA multiples, the valuation tool that's shaping billion-dollar deals in 2024. Hey everyone, welcome back to Jiro's channel, your go-to source for a depth and clarity dive into finance with some thought-provoking topics. If you're new here, make sure to hit the subscribe button and click the notification bell so you never miss out on our latest updates. Whether you're a seasoned investor or a curious entrepreneur, understanding this valuation technique is crucial in today's fast-paced business landscape. EBITDA, or earnings before interest, taxes, depreciation, and amortization, has been a go-to metric for decades. It offers a snapshot of a company's operational performance, stripping away factors that can vary widely between businesses. In 2024, it's more relevant than ever. Let's break down the EBITDA multiple method. Calculate EBITDA. Start with net income, then add back interest, taxes, depreciation, and amortization. Determine the multiple. This is where art meets science. The multiple can vary widely based on industry, company size, and market conditions. Multiply EBITDA by the chosen multiple. This gives you the enterprise value of the business. The beauty of this method lies in its simplicity and comparability across different companies and industries. Now, let's walk through the process of determining an appropriate EBITDA multiple. Conduct a comprehensive industry analysis. Research comparable companies and gather historical data on their EBITDA multiples. Assess company-specific factors. Evaluate financial performance, competitive position, and growth prospects. Consider market conditions. Look at the economic outlook and recent M&A activity in the sector. Apply valuation techniques. Use comparable company analysis and precedent transaction analysis. Make adjustments. Factor in company-specific characteristics and current market conditions. Consider a range. Instead of a single multiple, use a range to account for different scenarios. Seek expert opinion. Consult with industry professionals to validate your analysis. Remember, while EBITDA multiples are powerful, they're not perfect. They may not fully capture capital expenditure needs or working capital requirements. Compared to other methods like revenue multiples or discounted cash flow analysis, EBITDA multiples offer a balance of simplicity and insight. They're particularly useful for comparing companies within the same industry, but may fall short when evaluating high-growth tech firms or asset-heavy businesses. In conclusion, EBITDA multiples are a valuable tool in any investor's or business owner's toolkit. They're especially useful for initial valuations and as a starting point in negotiations. However, they should be used in conjunction with other valuation methods for a comprehensive assessment. If you found this video helpful, be sure to check out our next video on advanced business valuation techniques. And don't forget to share your experiences with EBITDA multiples in the comments below. Have you used this method before? How accurate did you find it? Let's discuss.